Hello and welcome to this session in which we will keep working with partnerships. In the prior sessions, we looked at the general partnership. Specifically, we looked at formation in one lecture. We looked at rights and obligation as well as sharing profit and loss in another lecture. So this was the formation of a general partnership. Session 2 was rights and obligation, sharing of profit and loss. In this session, we would look at distribution, dissolution, and dissociation. Also, we looked at joint venture partnership and we said it's very similar to the general partnership. We'll also eventually look at limited partnership as well as limited liability partnerships. Those are the various types of partnerships you need to be familiar with. Let's go ahead and get started to discuss distribution, dissolution, and dissociation. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
Starting with compensation. In a general partnerships, partners typically do not receive a direct compensation. Simply put, they are not employee of the partnership. Who are these? These are partners. Partners are not employees unless there's a specific agreement stating otherwise. But generally speaking, there's no entitlement to compensation. Now why? Because they are not entitled to receive payment for services rendered for the partnership. So hold on a second. Am I working for free as a partner? No, not at all. Your contribution in form of service, in form of time, is considered an investment. This is because the contribution, whether in form of capital, skills, or labor, whether you contributed money, you contributed skills or labor, are considered part of the investment in the partnership. So you're not going to be getting compensated for something you are technically being compensated for in form of what? In form of ownership. For example, let's look at a partnership called Tech Innovators, formed by Sarah, Raj, and Lynn, and the purpose is to develop software. Sarah and Raj contributed to the business financially. They contributed money, while Lynn is a skilled programmer, contributes by developing the software. So Lynn, how much did Lynn contributed? Zero. Nothing. If there's no specific agreement stating otherwise, Lynn would not be entitled to receive extra compensation for her programming work, even if Sarah and Raj are not directly involved in day-to-day operation. Now why? All partners, including Lynn, would share in the profit of the business as their compensation. So you work for the partnership as a partner, work in quote, you are contributing to your investment. Therefore, you get compensated when you share the profit. But there would be no additional pay for the work done. So you don't get paid unless there's a specific agreement. And this principle emphasizes the idea that partners' contribution, whether capital, skills, or effort, are an integral part of the role as a co-owners of the business, and their primary return comes from what? Shared profit. Remember, to have a partnership is you have to have a shared profit. Let's talk about dissociation in a partnership. Dissociation in a general partnership refers to a change in the makeup of the partnership due to a partner ceasing their association, stopping their association with the business. Now, just because one partner ceases, it doesn't mean this automatically leads to the dissolution. It means the termination or widening up of the partnership. Dissociation and dissolution are two different things. We're going to see what dissolution is shortly. Dissociation happens when a partner's withdrawal. You could always withdraw from a partnership. The person passes away, they die, they declare bankruptcy, or expelled, or if a specific event mentioned in the partnership agreement occurs that lead to their dissociation. There might be some event that if that event happens, you leave, you get married, or whatever. It doesn't matter what the event is, there's an event. And a partnership without a fixed duration, which is most partnership, or partnership at will, it means anyone can leave at any time. A partner can enter association at any time through a notice of withdrawal. Now, you could always withdraw. There might be some legal consequences to it, if there's any agreement between you and the other partners, Otherwise, you could always withdraw for sure. No one can force you to stay in a partnership. Once dissociated, a partner loses the right to participate in management of the partnership. However, you might still have what's called apparent authority. So you can no longer manage the partnership, but in the eyes of third party, you might be able to bind the partnership to an agreement, because in the eyes of third parties, you might still have apparent authority. So what needs to happen once a partner leaves, the partnership should notify existing customers, make a public announcement that this individual is no longer associated. A disassociated partner remain liable for debts and obligation incurred by the partnership before they left. So are they responsible for that? Yes, they're responsible for any debt that was incurred before they left. Why? Because they were part of this partnership. I hope this makes sense. Unless there is a release by the creditor. What does that mean? It means the creditors agree to do what? The creditors agree to have you off the hook. What does that mean? It means they say, you know what? In any case, and something happened, we're not going to go after you. It means what? It means you're no longer responsible for that debt. That's basically what it means. Or there is innovation. What is innovation? The innovation is a legal concept. And what does it involve? It's involved the substitution of an old contract with a new one. Simply put, someone took over this partner's creditor, replaces the original person. So the novation, it's new. Novation from the word new. Novation means this partner is disassociated. Someone else took over their responsibilities. Therefore, the partner that left is no longer responsible. Now, for debts incurred by the partnership after dissociation, the dissociated partner may still be liable for up to 2 years unless they give notice of their dissociation. So you want to make sure you let everyone know that you're no longer associated with this partnership. Why? Because what happens sometimes, if your name is still associated with a partnership, somebody might give them a loan because of your name, because they think you're still working there, and because of that. So you want to make sure you get your name clear, otherwise you could still be liable. If a new partner joins the partnership, they are not personally liable for that incurred before their admission. And I hope this makes sense, because you were not there when that incurred, therefore you are not responsible. Example, let's assume in a partnership called Green Garden, if one of the partners, Jane, decides to leave the partnership, this is an event of dissociation. Following her departure, she's no longer have any say in the management of the company, but she might still be liable for certain debt incurred while she was a partner. Green Gardens need to inform relevant parties of Jane dissociation to limit her apparent authority as well, and potential liability for new debt. And we say potential, it doesn't mean, but she could be liable if another person gave them a loan based on Jane's involvement in the partnership. Let's move from dissociation to dissolution. Here we are going out of business, we're closing. Dissolution occurs under certain condition leading to the winding up of its business, basically closing the door. Event leading to this is a partnership without a set of expiration date, which is partnership at will, can dissolve if a partner withdrawal. If a partner withdrawal, they can say, you know what, that's it. We decided to close the door. Or if the court orders the dissolution, orders the termination. Now, bear in mind, the death of a partner does not automatically dissolve the partnership. The remaining partner can decide to continue the partnership within 90 days of the partner's death. They can keep on going. Now, continuation post-dissolution. After dissolution, the partners does not immediately, after dissolution, the partnership does not immediately cease to exist. They need to kind of sell everything, pay the creditors, pay themselves, and close the business. It continues during the winding up process, where there is affairs to settle, an obligation to fulfill. You just don't stop. It's not like you press a button and the business is closed. During this period, partners would still have apparent authority to act on behalf of the partnership and are liable for its obligation. The partnership is officially terminated only after the winding up process is complete. Basically, the whole business is closed. For example, Bright Ideas, a partnership formed by A, B, and C, Elise, Bob, and Carlos, with no specific end date. If Carlos decides to withdraw from the partnership, this triggers a dissolution of Bright Ideas. Despite this dissolution, the partnership that does not immediately end. Elise and Bob must go through the process of winding up the business, which involved settling debt, completing ongoing project, and distributing any remaining asset. During this time, they will have authority to make decisions and enter into necessary contract, transaction to close the business. So the partnership officially closes when all these activities are completed. Now let's talk about the order of distribution. So once we close the partnership, eventually we're going to have to take all the money, take all the assets, sell them, and distribute the money. How do we distribute the money? How do we liquidate the business? When a solvent general partnership is dissolved, solvent means their assets more than their liabilities. There's a specific order of distributing its asset, especially when these assets are converted to cash. What is the order of distribution? First, you got to pay the creditors. The first priority is to settle any debt owed to creditors. Now, those creditors could be internal, could be external. External means external to the partnership. Internals, the partners themselves could lend money to the partnership. You have to pay them back that debt. Then you have to pay back the return contribution to partners. What does that mean? It means the partners will have a balance. After all creditors are paid, partners are entitled to have their initial contribution returned to them. This step ensures that partners recover their investment in the partnership. Anything left, you divide any remaining profit. If there's still funds available after paying creditors and paying shareholders returning contribution, this remaining amount is considered profit. This profit is then divided among the partners. Also, if there's a loss, partners must share in the loss. Now, how do we share the profit and the loss? This is from the prior session. If there is no agreement, it's equal. If there's an agreement, 50, 30, 20 for the gain, the same percentage will apply for the loss. Let's take a look at this example. Creative Minds, a graphic design partnership formed by Emma, Ryan, and Zoe. Upon dissolution, they liquidate their assets, which amounted to $100,000. It means they sell all their non-cash asset, and now they have cash of $100,000. What are they going to do first? They're going to pay the creditors. First, they pay off $50,000 of various creditors, including $10,000 owed to Ryan. Ryan seems to be a partner and a creditor to the partnership. So if they paid $50,000, they still have $50,000. They return the initial contribution to Emma, $20,000, Ryan, $10,000, and Zoe, $10,000, which is up to $90,000. With $10,000 left as profit, it divides equally among Emma, Ryan, and Zoe, assuming there is no alternative profit-sharing arrangement in the partnership agreement. Now, if the assets were insufficient to cover the debt and contribution, they would similarly share the shortfall. So if there's any shortfall, they will have to absorb that shortfall. Take a look at this multiple choice questions from farhatlectures.com. Upon the dissolution of a partnership, in what order are assets distributed? So simply put, when we sold all the assets, now we have the cash, we're going to distribute the cash. In which order do we distribute the cash? Do we pay partners first, then creditors? Do we pay all partners equally? Do we pay creditors first, then partners? Based on the percentage of capital contribution. How do we distribute this money, the funds that's available? What do you think? Well, guess what? First, we have to pay the creditors. We have to pay the creditors. Why? Because the creditors are outsiders. They lend us money. They have a legal claim against us. As owners, we're going to be paid last. So first, we pay the creditors. Anything left goes to the partners. Therefore, the answer is C as in Charlie. What should you do now? You want to go to Farhat Lectures, look at additional MCQs. That's going to help you whether you are studying for your CPA exam or taking an accounting course. Invest in yourself. The CPA exam is worth it. Good luck, study hard, and of course, stay safe.